Hello and welcome to the first edition of House Calls. This is a new series brought to you by The Australian. I'm James Kirby, I'm the wealth editor of The Australian, and over the next 3 weeks, over the next 3 Wednesday evenings, we plan to show you how to become a property investor and how to get started in this very interesting, useful, lucrative area of investment. But it needs great care, it needs great attention. And of course, the whole thing about property is it's all about in the planning. And you have to learn how to know what you're doing, how to finance, how to make those crucial first decisions, because in many ways, you don't get a second chance. And we know we have a lot of readers and listeners interested in the property market. So as I say, over the next 3 Wednesday evenings, we've got a range of experts to talk with you and to you, and we'll take questions about the property market. So tonight, I've got 2 people who I talk to regularly, who I find absolutely terrific on this area. I've got Martin North, who is the principal analyst at Digital Finance Analytics. You may well know Martin. He is a clear, authoritative voice in the property market, and always happy to take whatever pragmatic stand he thinks is best and fairest, I think, to all concerned when it comes to the crunch. Martin, how are you?
Yeah, very good, James, and nice to be on the show. Thank you.
Thank you for coming on. Now, tell us, just to let everyone know where you're coming to on the property market. There's been times, I think, in the past where you were quite vocal in your skepticism about the enthusiasm, the endless, irrepressible enthusiasm that people in Australia have for houses, house prices and residential property. Where do you come from at the moment? Where are you sitting right now?
I'm sitting on the cautious edge, James. Look, the fact is we still have very high debt. We still have very high house prices relative to anything you can possibly imagine, right? And we have a government that's driving the housing sector as a way of trying to support the economy. But that said, there are people buying and doing quite well currently, but you've got to be careful about what you buy. You've got to be careful about how you buy. And there are still many areas of the market where prices are continuing to fall, where people are in negative equity, and where, in fact, the pressure of trying to pay those mortgages are really holding people back. So time to be cautious, do the homework, get granular, analyze, but I'm not predicting a massive property crash in the next 6 months or anything like that.
Well, very few people are. Just one thing. So we see, I always take the big banks fairly seriously on property forecasts. I certainly take their forecasts as seriously as any, on the basis they have the numbers. They see them first inside the big banks. And so, of course, they said property prices would fall up to 10% or more, and they didn't. Now, from today, they're saying the property prices, this is across the board. Now, this is the average picture, everybody. It's not every house, but across the board, the dwellings, as they call them, across the nation will go by something between 10% perhaps next year and something like 20%, 14, 15 to 20% over 2 years. Is that a reasonable forecast, Martin, or is it, what would you think of it?
Well, I think it's at the optimistic end, but the Reserve Bank's modelling says that if rates drop 100 basis points over 3 years, prices go up 30%. So we know that lower interest rates have a direct translation into prices of property. However, you've also got to take account of the debt burden we've got, and how much more people can actually borrow, which is, I think, probably lower than what the banks think. And you've got to remember, we are way over the long-term mean. So that what says to go higher above that is going to be tougher. So my own view is that's probably at the top end of expectations. And I think the broader economic questions here about the state of the economy and all of those things are yet to play out. So my own scenarios suggest over the next year or so, on one scenario, a 5 to 10% rise is certainly feasible, but there are also scenarios on the low side too. So
sure. All right, very good. Thank you, Martin. Now, my other guest tonight is from the Wakelin Property Advisory Group. He's the director of that group, and his name is Jarrod McCabe. Jarrod is, by day, he is out there as a buyer's advocate. And I find Jarrod is marvellous for expressing and giving us the idea of the pulse, if you like, of the property market that you are about to enter or perhaps re-enter, or in some way engage with as an investor interested in what we're doing here. Hi, Jarrod, how are you?
I'm well, James. How are you? Thanks very much for having me.
You're very welcome. Tell us, what's the mood like out there? We know investors aren't really coming through in the numbers, in the statistics, that they're at a sort of cyclical low as participants in the market, but maybe they shouldn't be. I mean, maybe now we're at this point where rates are still low. The big banks are forecasting good price increases coming through. First home buyers are in there with their ears pinned back now. Admittedly, they got lots of grants that you don't be getting as an investor. But what's the pulse like across the country for investors? Is it all window shopping, or is there some real activity happening?
No, I think it's building. The competition from investors, they're starting to come back into the marketplace and certainly starting to be more active. As Martin said before, I mean, the interest rates being as low as they are, it's making purchasing an investment property as affordable as it's been for a long period of time when you've got interest rates as low as they are. And if you're buying the right type of property, rental returns are actually still okay at the moment. If you're looking at apartments in inner city locations where there's been an influx of supply coming into those sorts of parts of the country, because we haven't had as much of a take-up, say Airbnb type accommodations not there, so a lot of landlords in that space have reverted to putting their properties on long-term leases. It's meant that there's been an influx of supply and little demand for that type of property. So if you're looking at apartments, yields have certainly come back, not because of price growth, but because of dropping in rental values. But if you're looking at housing sectors, particularly some of the inner city cottages and terraces in some of the metropolitan areas around the country, demand for that type of rental property is still quite good. And so as a result, it's meaning that things are relatively affordable at present.
Okay. Now, as I said, everybody, the idea is over the next 3 Wednesdays, we're going to talk about different aspects of the market. Tonight, in this segment, and each segment is sponsored by Bricklet, we're going to try and get started, right? So this is sort of elementary, let's get started, let's figure out how to get going in property. So Jarrod, in terms of value, it would seem, I mean, the line I love in property is that, you make your profit when you buy. And it says you've got to get it right at the start. So I'd like to talk to you both about where you think value is out there at the moment, geographically or structurally. It doesn't really matter. Is it townhouses, in Adelaide? Is it apartments in Melbourne? What is it? Where is it? Where do you think value might be, Jarrod, in this market? Well, if someone asked you that question sitting across your desk, how would you begin to answer that?
My first point would be that you don't necessarily make your money when you buy. You make your money in selecting the right asset. So if you don't select the right asset in the first place, it really doesn't matter how well you buy it. It's not going to perform. Now, philosophy around investing in property should be a long-term thing. And so it needs to be a long-term prospect and objective. So you're not focusing on making a profit within the first 6, 12 months, 2 years. It should be a minimum of a 10-year exercise. So have that as the mindset when you're going into buying a property, and don't think about, well, I'll be selling it and flipping it in 2 years' time, because...
Just on that now, okay. But how many people actually do that, hold for 10 years? I mean, does it happen very often?
Majority do, if they're doing it for the right reasons, and they've got the right objectives, and as you said just before, they've got the right plan in place when they start their process at the beginning. If you've got the right philosophy and the right plan, then that will be the objective, and you've got to give the property time to perform. If you don't, then you'll find out that the costs that are associated with both buying and selling property will catch up with you and eat into any potential profits that you may make.
And where might be the value pockets be?
I mean, there's certainly value in the apartment market, but there's reason for that. And I don't necessarily think that should be something that's pursued, because there is so much choice there, and that's going to continue on for the time being. Now, when I talk apartments as well, in that sense, I'm meaning that there's value in the high-rise multi-storey sector off the plan. There's a very different type of apartment market when you're, for instance, looking at an Art Deco apartment in a block of only 4 in a street in inner city Sydney or Brisbane or Melbourne. That's a very different type of apartment market. So there always needs to be that differentiation. But I think there's certainly different pockets around the capital cities, around Australia that are performing quite well. But some of the regional areas, perhaps within an hour or two of the capital cities, are doing quite well at present as well. Whether that's
I saw where you said somewhere that you were a little skeptical about this.
I think it's a short-term sugar hit. That I think that there'll certainly be that for a period of time. And I think when you take some metropolitan buyers out and put them into smaller cities, smaller towns, it's going to, if you put 5, 10 extra buyers into that market, it's going to have an impact. If you take 5 or 10 buyers out of a capital city, it's not going to have the same level of negative impact on those areas.
Interesting. All right. There was always this thing that you can move out. Certainly, this has been true up to now. Maybe it won't be true in the future, but there was always a thing you could buy cheaply in regional Australia, but you couldn't come back to the city. I wonder, will that change? At this point, I might just move to Martin and just get his helicopter view here because I know this is very much your issue at the moment. I mean, it's always the issue, all property is local, but there's a couple of points you really want to make about the selection process within the market. Tell us where you're coming from.
Yeah, absolutely. So it's quite clear to me that you can't just talk generically about buying a property. You have to go granular. You have to look at different types of property. My own view would be don't touch high-rise developments, particularly new ones or relatively new ones in Sydney or Melbourne at the moment. Their prices are dropping there, are still dropping there down 20% or more. And the rentals that you get are also dropping. They make no sense economically, so avoid those. I also think that as just touched on, some of those low-rise Art Deco apartments are definitely more in vogue. But then I'd look at houses and I'd look slightly further out. But I don't think that New South Wales or Victoria makes a lot of sense in terms of investment. If you look at returns in Tasmania or Adelaide or up in Queensland, the net and gross returns are nearly double what they are in New South Wales. So I would be looking...
Over what time period, Martin?
Say that again?
Over what time period?
Well, the current running rate. So I'm looking, and just to be clear, there's a thing called gross yield, which is the ratio of the price versus the rental stream that you can get, assuming you can get somebody to live in it all the time. The net rental yield is the real one people should look at. People hardly ever do, but should. That includes all the costs. That's the cost of the mortgages. That's the cost of maintaining the property, right? And you can get a net yield of 4-5% up in Queensland or down in Tasmania. You're looking at 2% or below in Victoria, right? And so the point is, you've got to do the maths, you've got to do the sums, you've actually got to look at the real numbers. Don't be deceived by the so-called gross rental yields that people always quote. They are very misleading.
Yeah. You find out about the net rental yields when you actually own property.
That's the real number.
The endless bills that pour in for them. So, and that's assuming it's all going well. No big surprises, fully rented, etc. How do we find out those numbers? Where would we get the gross and the net yields? The net being the one to watch, the one that matters after all the costs.
So you can easily get the gross rental yield because that's the price versus the expected rental. But be careful with the expected rental because not every property is going to be fully let the whole time, right? The banks assume an 80% rather than 100% let. So maybe shade that. On net terms, you've got to think about the costs of the mortgage, the costs of servicing the property, you know, it might be a strata fee or whatever else it is, and maintenance costs and all those things too. So you've got to build yourself a spreadsheet, I think, or if you don't build one, go find somebody who's got some of those tools. Put all the numbers in and then run some scenarios on what rates, major interest rates. What happens if interest rates go up? What's going to be the effect? What happens if the strata fees go up? What happens if, for example, suddenly there's a defects that come up and you're going to have to find an extra $20,000 to pay for cracks that have appeared? How are you going to cope for that? That's the real data that you need to know whether you've got an investment that's going to work or not. And then run it over at least 5 years, if not 10 years. And then you will know whether, in fact, you've got an investment property that's going to work. Don't assume that the only thing you're going to do is make money on the capital appreciation. You've got to look at it as a running business.
Okay, very good. Thank you, Martin. Look, I think, folks, just at this point, there was something on the halfway mark. I hope you're enjoying it so far. I hope you get the opportunity to send in some questions. We're just going to cross now and have a word from our sponsor, Bricklet.
If you're like many Australians, buying a property feels out of reach. Bricklet is here to change that, with a chance to get started from as little as $25,000. Bricklet takes properties and fragments them into smaller, more affordable pieces, or bricklets. When you buy a bricklet, you become a part owner registered on the property title, offering you a real start in property and access to real estate income without the big deposit or mortgage. Start building your property future with Bricklet.
Very good. Welcome back, everybody. Now, the man on the street, Jarrod McCabe, who is out there, folks, and really knows the market. He's a buyer's advocate, standing beside some nervous property investors or enthusiastic property investors, perhaps sometime. I want to ask you, Jarrod, on the big picture, one of the things it's not that the economy is going so great. In fact, there's not much in the economy that would suggest you should be buying property right now. I mean, there's a looming gap coming up with immigration. There's no international students coming in. There's pretty obvious things that are drawing away from the market. So one of the things that everybody is so keen on, of course, is that it's never been so cheap to get a loan. And now the banks are out there giving loans again. And so people are operating on the basis that their mortgage is 3% or something. The long-term average in our market for mortgages, home loans, is 6 to 9%, and it can run up much higher than that. Ran up into the teens one time in the early 90s. So when you're talking to people and they're talking about rates, what do you tell them? Do you say this is like as good as it gets? You have to work this into your numbers that this might move against you?
I mean, I'm not in the financial advice space, so I'm not typically advising them what they should or shouldn't do around their borrowing capacity, that side of things. But
yeah,
in terms of the case studies and things that we've run and we've looked at, in terms of out-of-pocket expenses at the moment, it really hasn't been much better than that in the time that I've been doing this job in terms of advising investors. So if you've got the capacity, and that's the key part to it, it's got to be the right time for you. And if it is, as I said before, buying an investment property is a long-term exercise with the focus primarily being on capital growth. And if you do select the right asset, then over the long term, it will perform for you, it will build equity, and it will create benefits for you. So the rental yield side of things is important. And so we're looking at that side of it as well to make sure that there is benefit and that you are going to get the return to be able to sustain the ownership, make your mortgage repayments, pay off all of the ongoing expenses and make the appropriate allowances. But the capital growth with the right asset selection is the absolute key to it. So
when you get periods, obviously, in the market where the sellers are desperate, they're rare, but you get it. You get periods where the sellers are ridiculous in their expectations because they know prices are rising, so they start putting silly prices on the houses. What's it like out there at the moment across the country? Is it fairly reasonable and balanced? Because we are still climbing out of a recession.
Well, it's pretty strong. I mean, we're in Melbourne particularly, which is obviously where we're most active, but keeping an eye across the rest of the country as well. But Melbourne particularly at the moment, I mean, the last couple of weekends, we're seeing clearance rates in excess of 80%. Now, our philosophy normally is that if you've got a clearance rate in excess of 70%, it's a seller's market. If the clearance rate's sitting between 60 and 70%, it's generally fairly balanced. And if it's below 60%, it's typically a buyer's market. So to consistently see things in excess of 80%, and we had well over 1,000 auctions in Melbourne last weekend and are expecting to see the same.
Can I separate the clearance rates between the houses and the apartments that Martin is very sceptical about?
The difficulty there, but I 100% agree with Martin around the modern apartments, is that most modern apartments in that high-rise sector don't go to auction because there's not the depth in the market to justify putting them to auction, so they'll sell via private sale. So it doesn't typically give you an indication at the clearance rate around the level of activity and the level of demand for that apartment market, whereas the older style, established Art Deco, smaller boutique type development, where there is more demand, there's justification to put that to auction. And then
what about Well, we have, of course, tonight, this purpose of these events, these digital events that we're doing over the next few weeks, is to introduce people to property. At that introductory level, it's often the case that people can only afford an apartment, can't afford a house. And also, to the point that Martin was making about the costs of running an investment property, if you are fortunate enough to be able to buy a house, your operating costs are much higher than an apartment than a new apartment, because obviously it's just a physical deterioration of a house. So you have to allow for that. So what are the options? I know we said it loud and clear that the apartment market is vulnerable, Melbourne in particular. I'm sure parts of Sydney too, inner city areas in all the major cities, including Brisbane. But what about the people who can only buy apartments? Is there access points?
Yeah, there is. I mean, there's established older style apartments that have got greater scope because there's greater notional land components to them, and they sit in better locations typically than what the modern apartments do, because they're in quieter residential streets, but still have access, if you're selecting the right ones, to good public transport linkages, to local villages, that type of thing. But depending upon if you're in some of the, say, middle ring suburbs of metropolitan areas, you can consider the more villa unit type market as opposed to apartments, where you've perhaps only got 3 or 4 on a development, and you've got a greater land component to that, which will drive growth as well. So there's certainly more affordable options. And again, those older style apartments, the maintenance with them is typically a lot less as well, because they don't have the pool, the lift, the gym, which push owners' corporation fees up significantly higher.
They often don't even have a front gate.
Profit, yes, but also to your rental return.
Okay. Now, Martin, I'm just picking up Jarrod's scenario there. So somebody is saying, okay, I can still get into the market if I follow the traditional rules, nice 3-story, 4-story apartment block, 8 people, 8 tenancies in it, good track record and everything. But I can see from the numbers that the rent demand is what I would worry about in that scenario. I'm having something of a parting of the ways with some of my colleagues in the Australian about this, because they're telling me that rents are soaring. I don't see it so far. And the rental demand, I mean, this absence of hundreds of thousands of people that were supposed to come into the market, who traditionally went into apartments and student accommodation, evaporating before our eyes for some time. Do you think that's is rental demand or rent, or the ability to rent or find a tenant, is that a weak spot in the scenario just now?
Yeah, hugely weak, and it's again patchy. But take the areas around universities, right? So if you look at the number of vacant properties in high-rise and low-rise, and even houses around universities, because of the lack of international students who never came back, that's huge. And in some cases, we're seeing rents down 20, 30%. We're seeing people unable to let property. I was talking to somebody the other day who's got 4 blocks of apartments in Sydney. None of them have any tenants, none of them. So he's just watching the needle go down to empty on the value of his investments, right? So, and the other point to make here is it's also international visitors. So quite a few of those closer into the city would have been short-term let, Airbnb, but people aren't coming from overseas. So again, lack of demand. That's why I say net rental returns is the thing to look for. You can't just assume that you're going to be able to let that property right the way through the year. Other point, of course, is that all the stimulus packages that the government has thrown to try and get people to buy, that's all about encouraging people to build more properties. It's not actually helping affordability. It's not actually really dealing with the root cause issues. So we've got this overhang of high-rise property, low-rise property in those areas. You have to be really, really careful. And if you look at the data on rental returns, and indeed, this amount of free properties that are around in some suburbs, you've got letting rates at 8, 10, 12% vacant. Those are areas you must avoid if you're not going to get your fingers burnt. Now, there are other areas, go further out, houses where the occupancy rates are very different. But you've got to look at that. You've got to go granular. You've got to get that data. One final point, auction clearance rates are rubbish because the numbers aren't correct. And we're still seeing low volumes relative to last year. So although everyone's talking the market way up, it's not. It's no better than it was this time last year, right? And remember the other factor which people need to bear in mind, incomes aren't rising. So, you can't assume that you're going to be able to have an income growth that's going to enable you to be able to sort of manage this through. You've got to be very careful. So be cautious at the moment. Be really cautious.
Okay, yeah. Now, Jarrod, when we look at apartments, when we look at people buying, we were talking there about the banks say, I didn't quite realise this before, the banks say, assume the apartment is empty for 80%, for 20% of the year. Would you give a guidance like that to someone if they are buying with you?
I wouldn't be buying a property that I would think would be vacant for that length of period of time.
Yes.
So if there was that level of concern around a property being vacant for that long, as Martin said before, that's a red flag. You shouldn't be buying a property that's likely to be vacant for that long.
And do you, in terms of houses, I mean, we've worked on a principle for so long that, the closer you got to the city centre, the more valuable the land was, simply per square metre. And now there is something of a change going on, and there is some serious changes perhaps in how people are going to work. They will want more space again. They want that ability to work at home. It's a Wednesday evening. We're all in our homes here, working. It's completely normal, but it wouldn't be normal once upon a time for most people. So the nature of housing is definitely going to change. And I think we may assume structurally. Now, how do you work that into what you're doing, Jarrod, in terms of, do you think it's making a difference when people are looking at homes as investors? Are they working in those factors, and should they?
They need to, absolutely. That all needs to be considered and taken into account. Whether there's definitely going to be changes long term for how we live. Whether it's going to be exactly the same as it is now, though, is another matter as well. So are we going to see people having to work from home 5 days a week, 4 days a week in 12 months' time is another unknown to a certain extent.
Okay.
It's not going to be the way it is now forever, but it's not going to go back to the way it was either. So there needs to be both considerations taken into account. But bearing in mind that some people are going to want to work from home, and having the flexibility of being able to offer that in the type of property that you're buying, both from a tenancy but also from a resale perspective, is an important consideration.
I'm very interested why you think the move to the regional centres is a sugar hit.
I think there's definitely people that are doing it, and it's going to suit some people, and they are going to be able to recognise that they are able to work from home. But there'll be others that will do it and will get 12 months, 2 years down the track, and will realise it's not the lifestyle that they wanted when the majority of people get back to some form of semblance to what we were before, that living in a regional town doesn't offer them the lifestyle that they perhaps were used to and want. Others, I know plenty of people that have actually made the move and are absolutely loving it and will continue to love it. But a lot of those too were probably planning to make that move in perhaps 5 years' time, and it was brought forward. So there may well be a bit more of an increase in the short 12 months, 2 year time that perhaps otherwise would have been done over a 5 year period.
So you think long term, the urban centres, the metropolitan centres, as property investment territories, will outpace regional centres as they always have?
I still think they will, yes.
Right, very interesting. We don't have much time left. Martin, I want you to tackle that question.
Yeah, I think that New South Wales and Victoria will languish for the next 5 to 8 years. I personally think that property price growth will be much slower than most people are thinking. I would look after March. I think that after the end of the JobKeeper, JobSeeker and everything else, we're going to see more people unemployed. We're going to see more people struggling. I expect the banks to start pressurizing some people to sell because they got mortgage pressure. So my own recommendation for people would be, don't buy now, wait. Wait to see how this plays out. You will not be missing the boat. There's always more property. And don't assume necessarily that those areas around Sydney and Melbourne in particular will come back. I think I agree with you, James. There is a structural shift going on. I don't think it's going to reverse. People are moving to Queensland. People are moving away from the urban centres of Sydney and Melbourne. And when you interview them as to why they're doing it, it isn't just short term. This is a real significant change in attitude. And I think that's going to play out over the longer term. That's why I'm saying Queensland and Tasmania and even Adelaide look to me better bets.
And I suppose to some extent it's furnished by the technologies that we have, the technologies we've been able to use this evening to actually talk to each other in different parts of the country. I think we'll leave it there for tonight, everybody. This was the first, as I say, in a series of 3. We hope to see you next Wednesday, same time, same place. Until then, I would like to thank Martin North of Digital Finance Analytics for joining me, and Jarrod McCabe from the Wakelin Property Advisory Group in Melbourne. Thank you.
Thanks.
Thanks, James.